Hello, and welcome to the Consistent Options Income Options Trading course. My name is John Richardson, and I'm the author of the course. As you progress through this video and the subsequent videos on the DVDs, I hope you'll find that this truly is a unique options trading strategy, unlike anything else that's out there. Let's get started. This first video will give you an introduction and a little bit of theory behind why we trade the way we do. Next video will cover some basics of the charts and graphs that we'll use during the course. However, after the course, there's no special software or tools that you'll need in order to trade this strategy. The next video will cover probability and some of the problems trading with probability, and also will cover some of the deceptions of probability. The next video will cover traditional trades and some of the problems inherent with the traditional trading approach, and this will kind of set us up for the types of problems that our strategy will solve. The next video will cover the rules, and it'll go into detail on different aspects of the rules. At this point, you may not be able to put all the rules together and understand them as a package, but that's what the monthly day-by-day trading is for, to really iron out how all the rules work together. But when you're done with this video, the rules video, you should have a pretty good understanding of each of the components of the rules. The next video will cover the spreadsheet. With the course, I provide a spreadsheet. We use it during the day-to-day monthly trading, and the spreadsheet video will go into detail, a little bit of detail about how the spreadsheet is set up and how we use it. The rest of the videos on the DVDs will be one video for each trading month, and it'll go day by day through the trading month as if we were trading for real, using real data, and we'll see how the trades come out. This will be your practical exercise to take the rules that you've learned and apply them in real trading. This is where everything should come together for you. Here's a quote I like to use frequently by H.L. Mencken. "There's an easy solution to every human problem, neat, plausible, and wrong." I think this applies to trading very well. At the bottom of the page here, I've listed some great ideas, some things that I've looked into. I could probably have come up with 10 slides of great ideas that I've tried. I'm sure a lot of you recognize some of these. But as we get into these great ideas and we try them out, we often find that there's some kind of problem, some kind of hole, some kind of problem we can't solve. And a lot of times when we get to that point, a lot of the developers of the strategies or systems will tell you that something is wrong with your trading approach or your psychology, and they'll maybe refer you to a coach or a trading psychologist. Our strategy treats trading, our money, as much more of a business, much more of a science, and you won't hear us talking about how maybe your trading approach is wrong. So as we move forward, we're going to be trading this as a much more mechanical, rules-based approach. Okay, trading directionally. Trading directionally is like driving with the driver's seat facing backwards. That's the way I think of it frequently. If you picture yourself in your car looking out the rear window and you see where the car's been, it doesn't necessarily tell us where the road ahead is coming or where it's going, or if it's going left or right or it's going straight. So a lot of times when we look at charts and we try to trade directionally, this is the problem we're faced with. We're kind of driving to the moving average, if you will. And a lot of people say, well, that's not a problem because I realize I'm going to take lots of losses, but my winners are going to be bigger than my losses. The problem with that is that often what happens is these strategies would have a small stop loss of some kind, so they can count on their 1 unit of risk. Their 1 unit of risk is always going to be the same. And then what they say is, well, I'm hoping that my winners are 4 times my 1 unit of loss. Therefore I can win much less than 50% of the time and still be profitable, which is true. However, the problem is that you always take your full loss, and sometimes your winners are going to be more than 4 times your losers. However, a lot of the winners will fall into a bell curve. They'll be somewhere less than 4 units. Therefore, this really impacts your profitability. There's a pretty well-known system out there that promises 40% wins, and seemed like a really good idea to me. And so I bought their software, and I looked at it very closely, and I actually coded up their strategy in TradeStation, and it turns out it's much closer to 20% winners than 40% winners. And that certainly obviously would impact profitability. And also a lot of the winners weren't all 4 times. Sometimes they were significantly less than 4 times the 1 unit of loss. So trading directionally is a very difficult game, and if you think about it in terms of sitting in your car looking backwards, you can understand how difficult it is to get it right. I've been trading since 1990, and I've been writing directional trading systems since 1990. I started out with a program called System Writer, which is the precursor to TradeStation. So I paid my dues trading directionally. I've written thousands of systems. I've literally gotten into rocket science. Mathematics has gotten, horrendous. And I've spent a lot of time coming up with ways to validate once I have trading systems to make sure statistically that, they're viable. And I've learned over the years that it's a really difficult game, and I was never able to solve the problem. Around 2000 I started getting into options. Obviously I started trading options directionally at first, but I've come around to, once I realized more and more that I wasn't very good at picking direction, to more of a non-directional approach. Obviously I tried some of the traditional non-directional approaches, but at the end of the day a lot of those systems are directional, and Iron Condor gets hurt by direction at some point. Systems that people think are non-directional actually do suffer from direction, very much so. There's basically 2 kinds of strategies out there. There's a low probability, low risk, high profit strategy, and that's kind of like, in the directional world, that's like trading with the trend. It's low probability because we're not able to catch a trend that frequently, because the markets don't trend all the time. They go sideways much more than they trend. It's low risk because as soon as the trend changes, we switch the direction. If we're long, we go short. If we're short, we go long. The amount of risk when the market's making that turn is small when compared to the profit. It's high profit because potentially if we get on a long trend, we can make a lot of money. In the options world, this is kind of like buying a long call or a long put. We have a fixed potential loss on that, whatever we paid for the call or the put, but it's low probability. The market usually has to move quite a bit to make those options profitable, and it is low risk because it's fixed, but if the market does move in our direction, we have unlimited profit potential, so it's high profit. The other type of system is the high probability, high risk, low profit. High probability directional system would be some kind of oscillator system where when the market's going back and forth, which it does most of the time, we're making small profits. It's high risk because if the market goes on a trend, we start losing, and we lose a lot more than the small profits that we've been taking. And it's low profit because the profits are small when you compare them to the potential losses. This would be very similar in the options world to selling options short. It's high probability because we're probably selling these options out of the money. Chances of the market getting up there is the same chance of the long options we bought in the previous strategy. They're about the same as those options going in the money. So having these options stay out of the money is a high probability situation. It's high risk because you have unlimited risk on a short option, and it's low profit because when the profits are compared to the potential losses, they seem small. Now what we all want is a high probability, low risk. What we really want is high profit. Our strategy isn't quite that ideal. However, we do have high probability because we win frequently. In fact, in our current track record, we haven't actually taken a loss. It's low risk because we're managing our risk aggressively, and while the profits aren't high, they're reasonable and they're consistent. The high probability gives us the consistent profits, and if we keep the profit goals reasonable, we stand to take very little risk. We're also out of the market most of the time, which further reduces our risk. One point I'd like to make about directional trading is that the markets are very efficient. One of the things I've learned over all these years is how efficient the markets are. The more you study trading and whatnot, the more respect you have for the markets. Now, I'm not saying that the markets are efficient in pricing. What I'm saying is they're very efficient at digesting the behavior of the market participants. In other words, if you think in terms of Microsoft, let's say, the market may not get the price of Microsoft correct. You'll have people on both sides possibly arguing that, whether they're using price to book, price to sales, PE ratio, or something like that, they can say the market's either overvalued or undervalued. In that respect, the price that the market sets probably is never exactly where most people would think it should be. so it may not be efficient in pricing. However, it's very, very efficient at digesting the behavior of the market participants. When you go into the trade with a long position or a short position, there's lots of other people, there are thousands of other people making decisions with different time frames and different directions, and the market is very efficient at digesting those behaviors, because if it wasn't, the markets really wouldn't work. And the more you work with the markets, the more you realize how efficient they really are, and you've got to have a lot of respect when you go at the market directionally. And this is the reason most directional traders lose. Coming up next will be the charts and graphs video. We'll go into some detail on the charts and graphs that we'll use during the course.